Welcome to our CFP exam prep discussion on insurance exclusions and riders. Today, we're diving deep into these critical insurance policy components that frequently appear on the exam. Let's start with exclusions. Think of exclusions as the insurance company's way of saying, we won't cover these specific situations. Understanding exclusions is crucial because they define the boundaries of coverage and protect insurers from extraordinary risks. For example, a typical life insurance policy excludes death by suicide within the first 2 years. Property insurance often excludes damage from acts of war or nuclear hazards. A common mistake students make on the exam is confusing standard exclusions with contestable periods. Remember that exclusions are permanent policy features, while contestability is a time-limited right to investigate misrepresentations. Another frequent error is assuming all exclusions can be covered by riders, which isn't always the case. Speaking of riders, think of them as policy modifications that either expand or restrict coverage. They're like accessories you can add to your basic insurance policy. Each rider affects both the premium and benefits in specific ways. Take the waiver of premium rider in life insurance. It ensures that if the insured becomes disabled, their premiums are waived while the policy remains in force. This rider typically increases the premium by about 10 to 15%. Let's break down the main concept of riders into three key aspects. First, riders are optional additions to the base policy. Second, they always modify the original contract terms. Third, they must be specifically requested and usually require additional underwriting. The accelerated death benefit rider is another important example that often appears on the exam. It allows terminally ill policyholders to access a portion of their death benefit while still alive. Many students mistakenly believe this rider automatically comes with all life insurance policies, but it's actually an optional addition that must be specifically selected. When studying for the exam, pay special attention to how riders interact with policy exclusions. For instance, a critical illness rider might cover specific diseases but still maintain exclusions for pre-existing conditions. The exam often tests this relationship between coverage additions and limitations. Here's a practical tip for the exam. When you see a question about policy modifications, first determine whether you're dealing with an exclusion or a rider. Exclusions always restrict coverage and don't cost extra, while riders can either expand or restrict coverage and typically involve additional premiums. Another testing point to remember is that some riders have their own exclusions. For example, a long-term care rider might exclude certain types of facilities or care situations. The exam loves to test these nuanced scenarios where multiple policy components interact. For real-world application, consider a business owner who wants key person insurance. They might encounter exclusions for high-risk activities like skydiving, but could add a rider to cover business-related travel. Understanding these distinctions helps both in exam preparation and practical application. Remember that insurance companies can't modify exclusions without the policyholder's consent, but they can sometimes change rider terms at renewal. This distinction often appears in tricky exam questions designed to test your understanding of policy modification rules. By mastering these concepts about exclusions and riders, you'll be better prepared for the CFP exam and better equipped to serve future clients. Keep practicing with different scenarios and always consider how policy modifications affect both coverage and cost.